If you run a seasonal business, holiday retail, landscaping, tourism, e-commerce with big Q4 spikes, or anything where money floods in for a few months and then crickets, you know the pain. Bills don't stop, but revenue does. Now, I'm not a CPA, so always be sure to check with one for any tax or financial advice. But today we're breaking down revolving credit as the ultimate tool for smoothing out those wild cash flow swings. We'll cover exactly how it works, real world examples, different options in 2026, best practices, and how to get started without getting burned. This isn't just theory, it is a game changer that keeps businesses alive and growing year round. So let's dive in. Seasonal businesses are everywhere, whether it's gift shops, crushing it in November through December, landscaping companies booming spring through fall, coastal restaurants packed in summer, or online stores riding the holiday waves. Revenue comes in huge waves, but expenses like rent, payroll, insurance, marketing retainers, and inventory prep are steady or even higher in slow times. This mismatch, it creates a recurring liquidity crisis. Cash flow problems are still one of the top reasons that small businesses fail. Traditional term loans make it worse with fixed monthly payments that don't care if it's your slow season. Revolving credit flips the script. Flexible access to funds you draw only when needed, repay when revenue hits, and reuse again. It's like a financial battery that charges in peak season and powers you through the off months. In 2026, with better data integration from Shopify, QuickBooks, and marketplaces, approvals are faster and limits smarter based on your actual seasonal patterns. Think of revolving credit like a reusable reservoir. You get approved for a limit, say 50,000 to 250,000, and then you draw what you need, pay interest only on the amount used, repay as cash flows in, and the available credit replenishes automatically. No reapplying every time. The cycle in action. So 1, get approved for a limit based on your revenue history and financials. 2, the slow season hits. Draw funds for payroll, rent, or preseason inventory. 3, peak season revenue rolls in, repay the balance. 4, credit is fully available again for next cycle. You control the timing perfectly. Not all revolving credit is created equal though. Here's what's working best for seasonal businesses right now. Business line of credit, which is the most popular. It's versatile for operating expenses, inventory, marketing. It can be secured or unsecured. Pay interest only on drawn limits. Limits are often in the $10,000 to $500,000 range. Accounts receivable lines, great for B2B businesses, seasonal work, landscaping, events, construction. Draw against unpaid invoices immediately. Equipment revolving lines for businesses needing to upgrade tools or vehicles off-season when prices are lower. SBA seasonal or cap lines. Government-backed competitive rates for businesses with proven seasonal patterns. Great if you have 2+ years of history. FinTech e-com focus lines. Many now integrate directly with your sales platforms for near instant draws based on real-time data. Comparison tip. Versus a term loan, fixed payments, less flexible, or merchant cash advances. Fast but expensive. Revolving lines win for ongoing seasonal management because they flex with your actual revenue. Let's make this real. Like a holiday retailer uses a line to stock up in October, November, right before the Christmas season sales hits. Pays it down in mid-January. Landscaping company draws in winter to retain their key staff and maintain their equipment. Repays fully by late summer. Avoids rehiring and trading chaos every spring. E-commerce apparel brand. Funds seasonal collection, production, and ad spends. And repays from the peak sales. Coastal restaurant or ski shop covers 6 to 7 months of slower overhead while prepping for the big rush. The smart ones treat it as a bridge, not as a crutch, using it to maintain operations, grab better supplier deals, and even invest in growth during slow periods. One tip from a 2026 trend: pair your revolving line with strong forecasting tools like inventory software or AI cash flow predictors to draw the right amount at the right time and minimize your interest. Maximize success with these strategies. Apply at the right time, right after or during peak season when your numbers look strongest. Document your seasonality. Bank statements, tax returns showing patterns help lenders set realistic limits. Use it strategically for high ROA moves like inventory that turns quickly or retaining talent. Monitor your costs. Shop variable rates, watch utilization, and repay aggressively in good months to keep interest low. Build business credit. Separate from personal to unlock better terms over time. So who qualifies? Typically 1 to 2 years in business. You can get 50 to 100,000 in annual, or who are making in 50 to 100,000 in annual revenue. Decent credit of 550 plus from some lenders. Seasonal documentation is a big plus. Some risks to avoid: overdrawing without repayment plan. Use it for non-essential spending or ignoring carrying costs. Start by reviewing your last 12 to 24 months of financials. Compare specialized lenders who understand seasonality versus big banks. Many fintech options offer fast decisions, even in 24 to 48 hours. And funding in days. Look for flexible terms that match your cycle. Revolving credit isn't about debt, it's about resilience and opportunity. It lets seasonal businesses operate confidently year-round instead of just surviving. Now, before you go apply for that loan, your books need to be in tip-top shape. I am a certified QuickBooks ProAdvisor, and I can help you get your books loan ready. Thanks for watching, and we'll see you in the next one.